Well, thanks everybody for coming. I wouldn't be surprised if there's some stragglers coming in. It sounds like there's some bad traffic, if you can imagine that in Nashville. Well, I'm excited that y'all showed up. I know that Netflix was an option tonight. There's all kinds of things you could be doing, but you guys are here expanding your brains and seeking information, which is awesome. And I'm telling you, you're not going to be disappointed because we have a great panel for you tonight. I've heard it said that, you know, those that sweat more in training bleed less in battle. And with that being said, the three individuals up here were handpicked because of their experience. They've been around the industry, seasoned veterans, so we wanted you to hear from them, and nothing against somebody that started last month, but these guys bring a little bit more experience, so we're excited to have them. So I will go through and introduce everybody here, and we will start to my right here with Mr. Jay Jackson. So Jay Jackson is with First Horizon. He's a TSU graduate, father, husband. He believes in working closely with his clients to identify and implement the suitable strategies for their financial situations by seeking to provide the highest quality of service that beats deadlines, eliminates roadblocks, and demands creativity. Jay has been recognized by several organizations for his leadership, management, work in consumer and business banking, and customer experience. Accomplishments include First Horizon Top Lending Branch for both consumer and business, and First Horizon's Diamond Circle Award recipient. Leadership in Rutherford County graduate, executive board member, as well as other numerous awards. He and his wife Morgan have 3 children.
And that's about the last one. Chris and Tommy know.
Actually, I feel like we're going in order of children here. So this is good. So next up, we got Brennon Gomm. Brennon he's with CapStar Bank. He boasts a distinguished 25-year tenure with the banking industry, commencing his professional journey during high school. Over this extensive period, he has demonstrated proficiency in various roles, including teller, personal banker, cash management, management officer, office manager, area manager, business development officer, business banker, and commercial lender. Brennon ardently embraces his role as a banker, emphasizing the cultivation and sustenance of relationships, both clients and colleagues. Currently serving as the commercial lender at CapStar Bank in the Nashville market. He remains steadfast in his commitment to assisting industry peers in achieving their objectives. Brennon has consistently excelled as a leader, a mentor, diligently ascending to positions that enable him to further contribute to his overarching goal. Having relocated from Seattle, Washington to Nashville 7 years ago, Brennon and his wife reside on a small farm near the city, dedicating their leisure time to 4 children. Beyond his professional pursuits, he is an aficionado. I'm glad I got that word right. Nature and music. Welcome.
Thank you.
And he likes big words. I appreciate that. Next up, we have John Cannon. John Cannon serves as Pinnacle's commercial real estate manager. John began his financial services career in 1996 before joining Pinnacle in 2015. He was a senior vice president and Tennessee market manager for commercial real estate at U.S. Bank, where he was responsible for developing and maintaining its commercial real estate finance portfolio. John previously held a commercial real estate role at PNC Bank, formerly National City Bank, if you guys remember that, in its special assets division and investment real estate finance group. He earned his bachelor's degree in economics and business administration from Hanover College and master's of business administration from the University of Louisville. How do you say it? Do you say Louisville?
The natives say Louisville.
Louisville, okay.
I've been gone 16 years, so I'm pronouncing it too hard.
Okay. That's okay. John also serves in the following capacities. He's a board member with Nashville Downtown Partnership, with the Urban Land Institute on the Capital Markets Committee, and Leadership Nashville Class of 2024. Welcome.
Thank you.
All right. Well, I kind of want to set the table. So the reason that we wanted to kick this off right here at the beginning of the year is there's a lot going on in financing. There's a lot of questions. There's a lot of confusion. It's not these guys' fault, right? These decisions are made at different levels than we all are sitting. But it's to kind of shine light on the industry and really get some answers from the horse's mouth. And it's also, as people in here, raise your hand if you are currently an investor or aspiring investor. Okay, we're in the right room. Good. So with that being said, it's also to give you guys tips as you go out and you make your relationships with lenders. What does that look like? How can we help you do that? What do they look for? You know, it's very rare that you get to hear what they would prefer that you have as far as your ducks in a row before you come in. So we're going to get into all that. What I've asked these guys is to be honest. That's it. Just be honest with your answers. We're all naturally in sales, right? But it's not, hey, come on down, we'll give you a loan on anything. Well, we know that's not true.
Be nice.
Yeah, it would be nice. Maybe we'll get back there. But they've all agreed, and that's why they were handpicked to be here, is because of their honesty and their experience in the industry. So one of the things that I do want you to keep in mind as we're talking, this is a snapshot in time. There is one thing that's consistent in real estate is what? Change. It's always changing. And it's going to continue to change. So everything, we were joking about this as we were coming up, everything we talk about today could change tomorrow, okay? But we're going to talk about how it is today. So first thing I want to get into, what are the primary factors impacting banks' commercial real estate lending appetite right now? John, I'll let you kick that off.
Yeah, and thanks. It's so good to be here. I so look forward to our discussion. And I want to start by thanking your sponsor, because you probably changed my plans tonight. I'm not going to go home after this. I'm going to go back to the office and start pulling our policies on the collateral. Yeah, making sure we're covered. But it's such an interesting time. I guess the three words I would use would be obviously interest rates, but maybe even more importantly in some institutions are concentrations and then liquidity. So maybe walking through that is there was a dynamic that occurred well before interest rates started rising, and there was a tremendous amount, and I think, you know, my folks up here would agree, we did a lot of fantastic loans on real estate. Real estate was where it was at, particularly in this city and a lot of metros throughout the Southeast. So a lot of banks were making a lot of loans on commercial real estate, and for the most part, I'd say most of those landed in industrial and multifamily projects. So a lot of lending had been done. Interest rates start to rise. So what happens when interest rates rise, a lot of our machines are built and predicated on, we do these loans, help someone buy an asset, get it stabilized, and then we count on it getting sold or refinanced to recycle that capital. And a big determinant of how that happens is interest rates. So as interest rates rose, a lot of our discerning clients said, you know what? I'm not going to sell this. I'm not going to refinance it right now. I'm going to keep it on the bank's balance sheet a while, and I'm going to see what happens. Because what they didn't want to do is refinance it in the permanent market, which is typically a 10-year loan, non-recourse with big-time prepayment penalties. So they didn't want to lock it up for 10 years. So they didn't want to sell it into an elevated cap rate environment. They wanted to take a wait-and-see approach. So all this stuff started backing up on banks' balance sheets. So it wasn't a credit issue, as many might think in a rising interest rate environment, even though the industry has those in certain asset classes, i.e. office in some cases. But all these fantastic loans weren't going anywhere. So banks had to become very cognizant of their real estate concentrations, because regulators look at that and investors look at that. So that's one thing that's still going on in a big way. Interest rates are still elevated, so loans aren't leaving our balance sheet. And to exacerbate that, guess what? All those loans that we did in the couple of years prior, most of those were construction loans. They're still funding up. So, for example, I know portfolios where folks didn't even do a new loan this year, but it still grew because nothing's paying off and those construction loans are still funding up. That's number one. That's kind of interest rates and concentrations together. And then the last thing I would say is all of that was exacerbated by Signature and SVB.
Yeah.
That really changed the focus from offense to defense and balance sheet and liquidity management. So it became a situation almost overnight where no bank in the industry is really rewarded for being an outlier in any way. So it caused banks that were had a lot of real estate activity to be even more conscious about those real estate concentrations. And that's still where things sit today, and why in many cases it's gummed up. It's not credit quality, it's concentrations.
Good.
Good answer. Do you guys want to add anything to that?
Yeah, the liquidity piece, I think, is a big topic right now for a lot of banks. It affects how we look at loans. During COVID, we got all this PPP money that came in, and it was deposited at banks. Those deposits for the bank become a liability on their balance sheet. It only becomes an asset when they lend it out. So we had a big chunk of cash come in that we had to lend out, which then was all the commercial real estate that we did, and it was fantastic. Well, as rates rose and the market changed, a lot of those deposits started leaving the bank, leaving every bank. And that's not necessarily a concern, although that's what we're lending upon. And so banks need to keep their assets and their liabilities, their loans and deposits, their liquidity above their loans. And so as we did all these loans and liquidity kind of came down, it became more equal. And so that causes us to look at it and say, what loans do we want to do? Because we have a decision to make. We can't do every single real estate loan because we need more liquidity in order to do it. So it's this game of kind of back and forth of getting liquidity and then lending it out. And I mean, that happened before all of this happened. Most banks are cyclical, if I can say that word. When they have a lot of deposits, they're going to have a fantastic loan rate, a special, they're going to lend it out. When maybe they did a large loan, $50 million loan, $25 million loan in a quarter, they're going to offer a higher interest rate to collect more liquidity so that they can go lend it out. So it's constantly going like this. But right now, I think a lot of banks are looking at their balance sheet saying, hey, we need more liquidity so that we can lend it back out.
Yeah, and I think just to piggyback off these guys, when you think about liquidity, it's all about you, right? You as a client, you as the person. And what happens is that a lot of real estate opportunities, they're exhausting all their liquidity to try to get that opportunity as well. Right? So one of the biggest things that you want to make sure of is, like, when you're going through this process, have a significant amount of liquidity prepared. Because what happens is that it may be the guarantor, you have to prepare for it. Hey, if this falls through, I might be still responsible for this. And to John's point, this may not be a non-recourse opportunity. You may be the guarantor. And it is a recourse opportunity, right? Meaning that, hey, if it falls through, it comes after you. So that's the reason why liquidity is very, very strong. So,
excellent. Good stuff. John, do you need water?
No, I'm good.
I just noticed we all have water. Okay. We had a couple of folks come in. Thanks for joining.
Distracting, what's going on?
No, I just want to make sure you have the option too. Since we have a couple new folks in here, I'm going to start over again on the bios. So, no, I'm just kidding. So kind of leading into that, and Brian did a great state of the market address at the beginning of this. And I know that there's a lot of variables in this question, but when it comes to lending right now, specifically at your guys' banks, is there a certain appetite for one sector over a different one? I mean, I know that's a tough question to answer, but is there something that for sure that bucket's full? We're not interested in that. We definitely could look at this. Is there anything like that? Whoever wants to jump in on that.
I could jump that off. Most banks, and I'm speaking in general, right? It's really about the business and the client, right? The guarantor and the business. Is the business making money? Is it profitable? What's your margins? Is the guarantor, it kind of talks about creditworthiness, right? How strong is their credit? How strong is their liquidity? You're going to hear liquidity probably throughout this conversation because it's that important. Your balance sheet needs to be strong. The liquidity that goes into your balance sheet needs to be strong. You as that guarantor, you need to be strong, meaning that you can't go below your personal credit because it's needed. So if I can give anything from that, that'd be one of the key factors there.
Excellent.
I would say I would look at our approvals over the last, maybe a couple quarters, I think there's been a major shift from commercial real estate as a whole to CNI. I don't think it necessarily, so mainly owner-occupied real estate has a business in it. And that kind of correlates to that liquidity, once again, because a business would have income and have an account. They would have account services, remote deposit. An investor might have an account, but very little liquidity because you got to keep your cash to the next project, right? Us as a bank, we haven't necessarily stepped away from any bucket right now, but instead we take it from an aspect of what does the bank benefit from doing this loan. So if you have an apartment complex, just a duplex or retail, you name it, what does the bank gather from that? If we're just doing a straight across loan and it's just, one loan, no deposits, it's going to be difficult to approve. Now, it may be the best thing that you've come across that we've seen, but we do have to keep those considerations between our liquidity and our loans. And if we're only doing loans, then we're going to fall short on our liquidity. So no deal is off the table. I don't think. Maybe hotels. I think we all kind of agree on that. But for us, if it's a good business opportunity and all these pieces fit together, then we're going to do it.
And I would say, keep in mind, I'm a real estate guy. That's all I do. So, I'm going to speak specifically to commercial real estate. And I would say transactional business is dead right now. It's all relationship driven because of the capital constraints.
Yeah.
So maybe with an overlay of not a whole lot at all is getting done in the commercial real estate world right now from a lending perspective due to the things I mentioned earlier. Let's look at the asset classes real quick. What makes sense and what doesn't? That's kind of how we base our decisions on what we want to do and lend on, and same way that you're making decisions on what you want to invest in. It's really hard to make a real estate deal pencil right now. Costs are outrageous. Insurance costs have gone through the roof. Interest rates are up, and hard costs were high before all this started. So it makes it very difficult when you combine that with what you heard in the market report. In most cases, rents are flat. So the deals just don't pencil. But if I'm stack ranking, and I'll just be completely transparent on what would be probably most desirable to least desirable, you generally have multifamily and industrial at the top of the food chain, because you're still seeing in a lot of markets, Nashville in particular, but strong southeastern markets, you don't have demand problems, you have temporary supply problems because they're hot markets. People come in and they build a lot of apartments, but people continue to move and businesses continue to relocate, so they generally get absorbed. So multifamily industrial demand is still strong. You heard that earlier. Below that is probably retail, and I like that market report because we've seen the same thing. There just hasn't been a lot built in a long time except retail build-to-suits, your Starbucks, your Zaxby's, whatever. So that's still in favor. Once you get below that and you get into hospitality, that's still a tougher sell. Office is a four-letter word, I'll be honest. Office is really difficult right now because we haven't really found what the new normal is for the space usage, right? So that's about as candid as I can get. That's kind of how I'm seeing real estate play out throughout the market, throughout the industry.
Excellent. And to piggyback off of that and to tie into deposits also, what does a down payment, what kind of, weight does that carry? Obviously, we're hearing down payments are increasing out there. If somebody has the ability and liquidity to put down a bigger down payment, how influential is that on your underwriting decision, number one? Number two, where do you think that's going in the future?
Typically, kind of across the standard, you see about 20%.
Okay.
That's kind of your normal. You hear about 20% down. And it goes back to the guarantor or the business, right? That 20% is kind of that standard. However, you may have to put more, right? It really depends on the deal and how viable and be able to pencil that deal is. So, you may see some specials, don't get me wrong. You get some people to say, hey, we may give you 5-10% down. However, always read those qualifiers to get that 5 or 10%. Because you would be amazed how you'd be like, oh, I can get 5%. I got to have an 800 credit score. I may have to have, $1 million in deposits.
You have to pledge your children.
Pledge your children, right? So there's a lot that may have to go into it. So read those qualifiers. But that's kind of theirs.
They might give them their children. Carson, I'm not.
It's never you, Carson.
I would say you got to look at it from the bank's perspective. We all don't know what's going to happen in the next 5 years. We feel like Nashville might be protected from whatever's going to happen in the economy. We have wars on the table. How is that going to affect commercial real estate or real estate in general? And I think that's the perspective you need. Yes, we can do 20% down. Yes, there might be something where you get 10% down. Highly doubtful, but maybe. But the idea is if you put more money down, then the deal is going to look a lot better, because if the market does turn, then you're not going to be underneath the water. And then if it's a 5-year term, you have to refinance, or a 10-year term, you're still above. They want to make sure that they get their capital back if this thing fails. And so the more you can put down right now, and in the future it might be less, the better and stronger your deal is going to look.
Yeah. And I might share, again, purely real estate guy here, but it's just math. And when you have escalating costs, what generally collars the amount of loan proceeds that can be advanced on a project, it's its debt service. So you look at how much is a project throwing off in net operating income, how can that service, debt of X amount at today's high interest rates. And what I'm finding is, if you look at multifamily, industrial, almost any asset class, it's about 55 to 60% loan to cost. That's big money down. It didn't used to be that way. Going into the GFC, we were doing 100% financing on deals. It was a very different scenario, and I think coming out of that, 65, 70% became the new 85, 90% loan to cost. But now what I'm seeing is, if you do the math from a debt service coverage perspective, given the cost, project can only support a much lower amount of debt, and it can be 55 to 60% in many cases.
Excellent. Piggybacking off of that, as far as lending caps, and I'm sorry, I'm sure some of my questions for y'all are annoying because I know it's completely case by case, but are you seeing more caps on lending? Are you guys being told from underwriting that any kind of max, or just, again, deal by deal?
Deal by deal.
Yeah.
Yeah, there really hasn't been a conversation on it. We have in-house caps. There can be concentration with one particular borrower that a bank would be concerned about. But as far as deal size, I think it's just up to those. Yeah.
And I think for us, in a lot of banks, you have to look at it on more of a macro basis. Where are you overall in your real estate concentration as a percentage of your book or as a percentage of your capital? Because that's a regulatory thing that is taken very seriously, and you got to manage that. Sure. So long as there is room there, which in many cases there's not a lot of room right now in today's environment, it really becomes a product, as they've said, of the individual credit quality of the deal.
And exposure. So if they're more exposed, obviously there's going to be more caps, more limits put on.
For sure.
Yeah.
On the topic of non-recourse loans, what does that look like right now?
Well, you got to do loans for them to be either recourse or non-recourse right now. But my lens is primarily construction, and what I've seen generally is construction loans are a recourse business, but how they're generally structured is that burns down over time. So you may have 50 to 100% recourse during a construction phase. Once construction is completed, that may get cut in half while it's in lease up, while apartments are getting rented or an industrial building is getting marketed for lease. And then when it's stabilized, that recourse may, in many cases, depending on how much equity was put in up front, may burn completely off. I've seen more non-recourse executions in the term debt game, which I don't do a whole lot of, but that generally I've seen that's a product of how much money is put down. If you want to really push for that 80%, 85% loan to cost, and it makes sense if the numbers work, that's probably not a non-recourse deal. But if you're willing to put more cash in, and that's a 60% loan to cost deal, that probably some non-recourse options are on the table.
I also think that per bank, their appetite for non-recourse is going to change from bank to bank.
Absolutely.
Yeah, absolutely.
I think, for us, you have to be a very wealthy individual that can support the debt service of all of your debt 10 times over. Your skin in the game. If you have enough skin in the game, then that might be something that you need to do. But if someone were to call us and say, hey, I want to do this loan and I want it non-recourse, we don't know them, we don't know their history, if they paid on time, these type of things. So relationship also is an aspect that goes into it. But in my banking history, there's not too many, unless you get into kind of these larger opportunities that have a lot of guarantors or a lot of strength behind it, are you going to see non-recourse loans.
And I think it goes back to what you said earlier, your debt service coverage too, right? If you go to what your standard debt service coverage is, that's not going to happen. But if you have, let's say, maybe 6-7 times the debt service, it's possible. But it goes back to what we talked about earlier, the strength of liquidity that you are as a guarantor, and what does your balance sheet, what do you look like? Because you're asking the bank to take a risk on, hey, if this goes south, we don't come after you.
Yeah. And we tend to be relationship lenders, not asset lenders. Yeah. And there's generally a very efficient market out there for non-recourse lending, particularly on larger projects. Life insurance companies, Freddie Mac, Fannie Mae, the CMBS market, that's what they do. They do non-recourse term debt on real estate, and the rates are good. Non-recourse, they're fixed. So if a bank really wanted to compete in that game, it's how much more leverage will you give and how much will you drop your price, and that generally doesn't make sense from a business model perspective. So a lot of the non-recourse that I see is done via a different capital source, agency, Freddie Mac, Fannie Mae, or life insurance company.
No.
Excellent.
Can we ask questions?
Yeah, absolutely. Sorry, you guys can ask questions anytime.
So one of the things that with non-recourse, where we see that coming up more, is self-directed IRAs and 401ks. So what I'm hearing from you is that it doesn't matter what the LTV or DCSR is going to be. You're just not going to loan unless they have this big depository relationship with you, like in the $1 million liquid, if they're going to use their self-directed IRA. So talk about that, because it has to be non-recourse by structure in order for them to use that. Do you have any comment on that?
Yeah, I would say,
Thank you.
Yeah. Go take it off there.
I think that we'd have to take that, once again, case by case deal. I think if you had that and you were looking for the because it has to be, that I would go to a lot of different bankers and a lot of different banks and tell them what you're trying to accomplish.
Okay.
What it's going to take is a lender, relationship manager, to take the story and what needs to happen and bring it to an underwriter and go against the bank's policies, not against them, but with them, to determine if it's something that they have an appetite for. I don't think that is something that, at least I haven't seen a lot of for quite some time, I would say. So I think that's going to be a case-by-case basis.
We're one of the few brokerages that actually knows how to work with those. And so it's good to know who can and can't do that and who's willing to go through the hoops, because there are a lot of hoops. So thanks for letting me know.
I think it's an excellent point to find a banker that can take it to the bank as well in preparation for somebody that you want to refer over.
Sure.
Because once you get it kind of set up, and even if they have to write something new, a new policy, doesn't necessarily work for bigger banks because they've already kind of established those. But a smaller bank that is willing to go through that and figure it out to make it work.
Yeah.
Okay, thank you.
And it goes back to relationship too, right? The bank needs to know who you are when you think about that from a relationship standpoint. Because you're asking us to say, hey, would you take a look at it? What does it look like if you want to do a non-recourse loan? You have to qualify for that too. It's just we don't just give it out, right? So Just always just take that in consideration.
Yeah, and these guys, I mean, you guys have done a good job answering that question. It's not necessarily my lane. What I'm primarily involved in is where you'll have a developer that is partnering with an institutional equity source. So the individual investments in that transaction are happening by folks making it a decision to invest in one of those institutional equity platform funds that then ultimately are compiled and make their way into our project. So I'm so glad you were up here to answer that question.
Some questions for you guys. They don't mutually connect with each other, but the first one is I'd love for you guys to talk about how the laws changed from the bailout laws that we dealt with in like 2008, 2009 to the bail-in laws that are now there where the banks can actually take assets if there's no downturn to like re-liquefy ability. And so, which was passed, I think, in 2011. So if you guys could talk about that a little bit, how you see that playing out. The other one would be if you guys could talk knowledgeably about like Wall Street's acquisition of single-family homes, and that on the books, you have a goal to get like 40% of single-family rental home property ownership.
Nope.
Like the BlackRock
Yeah.
by 2030, and continuing to grow that to where they're, essentially basically a monopoly in the market. So are you guys, I mean, I see you're in there, you can take that one too?
I'm not. Key word that you said, speak knowledgeably, and that's not my lane.
I'll take maybe a little bit of the first one, and I can't say I know enough about it, and so I'll be honest. What I do know about it is that, and this varies from state to state, but for acquiring assets, if we do a loan and it's underwater and you don't make your payment, or no, let's say it's even above water, but you don't make your payment, we have to foreclose on it. The first thing we're going to do is go back to the collateral, and that collateral is hopefully going to pay off the loan. It's going to pay for the attorney fees, for the foreclosure fees, everything else. It's going to pay for that. If there's any extra, the bank does not get that money. In general situations, it goes back to you who has it. So we don't necessarily collect on that, right? So I say that's the first thing. If it's underwater, and that's why recourse is so important, but we will go after all the different assets that we possibly, that we're legally allowed to in the contract.
Yeah, and that's a slightly different question than what I'm asking. I'm talking about the solvency of the bank itself.
Oh.
Yeah, because under the bailout law, the taxpayers bailed out the banks. Mm-hmm. Under the new law, the assets that are from the depositors, so that becomes they're not going back to the tax, they're not going back to the taxpayer again. They're going back to the depositors.
Now
that's the bail-in. That's the bail-in law. They've changed the structure by which the banks stay solvent, and that's different than it was in 1933. It's different than it was in 2008. It's a new model that they've instituted.
Yeah.
I may be answering yet another question you didn't ask, but we're getting closer to my lane. So you'll find this interesting, even if it's not the answer. But one thing I found fascinating is this time around, there's a perception of we all as taxpayers are bailing out the banks, right? So here's what happens. Here's what happened with Signature and SVB. The losses that were associated with those two institutions, they get put into the FDIC insurance premiums in the banking industry. And guess what? The rest of us banks get to pay for that in increased FDIC insurance premiums, which at the end of the day has a trickle-down effect. I guess we're all paying for it anyway. But I found that extremely interesting. Maybe that nibbled around the edge of your question.
Yeah, it's probably all tied in together because there's a lot of banking consolidation going on where you're seeing this convergence up into the top 10 banks, like agglomeration, Wells Fargo. Mm-hmm. Yeah, you're seeing it, which happened back in the 1930s as well when the banks, the local banks went away and there was this consolidation. You're seeing that happening again. So. Yeah.
That's a big word for you, Brendan.
And I agree. I think you're going to see a lot more of that.
For sure.
I think the one thing that the FDIC and the Fed doesn't want to see is banks fail and make the consumer afraid to go with the banking institutions. And so instead, I think that they'll preemptively merge different banks if they have to, or banks are going to merge because they realize they're up against that rather than having to worry about these other hips doing time.
And I don't know if we fully know yet what the ultimate new capital requirements are going to be, that they're going to be higher than what they used to be, and that's going to to your point, I mean, that's going to probably spur more consolidation activity.
Yep.
It gets really fascinating when you look at like countries and what the rental ratio versus home ownership ratio is. And like, I think Romania is the #1 country for home ownership at like 98% or something like that.
Wow, sheesh.
Yeah, it gets pretty fascinating. Russia's actually, I think, at 80+% home ownership, whereas the U.S.'s home ownership continues to decline. We're at like less than 65% at most. What was my other question?
So corporations go on.
BlackRock. Let's just call it what it is.
BlackRock thing, yeah. If you guys can talk to that, I would love to hear something about that because that impacts single-family homeowners, but also the rental market in a big way.
Well, and I know obviously it's a panel of commercial, so I don't know how much of that, you guys get into with, I mean, there is a bill proposed right now, right?
Oh, I don't know anything about that.
Yeah, I think there's a bill, yeah.
To limit, or they're going to have to start.
They're going to have to start selling off.
Yeah.
Whether it goes through, who knows, but they're coming after, the focus is BlackRock, some other companies like that, to try to stop that monopolization, but also give them a deadline when they have to sell things off. Okay. Will that go through? I don't know. They have some deep pockets. We'll see. But all I'm saying on that is that's, it affects the economy, of course, but it's more on the residential side. Unless you guys have a point on that.
No, I know about it.
Yeah.
I have some opinions about it, but not that's personally.
Yeah, I'm sorry.
So, for all three of you, what does loaning on development look like right now? Like 0, 1%? I mean,
Yeah. Well,
I'm not.
Great question. I mean, I'm going to maybe just tie together a few things I've already said to answer that question.
Fair.
Is deals don't pencil. It's really difficult for a development deal to pencil unless someone's owned a piece of land for a long period of time and they can put it into a project at some ridiculously low cost basis. Let's say that happens and there is something that pencils, then you're competing with the industry-wide capital constraints. So it becomes a product of what does the relationship look like? So I'm involved in a lot of these discussions at Pinnacle as we're looking at different scenarios. And generally when I'll have a lender call me and tell me about a project, they jump right into the credit metrics of it. And generally what I see right now, anyone that brings a deal to a bank, the credit looks pretty good because I think folks generally know the state of the union and they're capitalizing and coming prepared. But generally what I do a few seconds in is say, no, hold up, let's not talk about that. What does the relationship look like? What's the deposits? What's the other business? Because I think one of you guys said it earlier, there are more opportunities than there is generally appetite. So now it's getting real to where you're stack ranking opportunities based on relationships. So I probably answered about 70% of your question, but that's what I'm saying.
Yeah. I have a related question to that. So, you said relationship a lot of times. Say back in 21 when everything was red hot, if you're new, basically everybody's like, forget you, I got my guys over here, right? For all getting stuff done. Well, now if everything's tight, things are slower, whatever. So you're not going to trust a new person either. So what's the best time to kind of start building that so that that new person who's getting started can actually, get along?
I'll answer that.
Yeah.
I'll answer it as an investor that now is the time to start with multiple different banks, your relationship with a lender, to get them to be an advocate for you and your projects coming forward, whether it's this year, next year. Get to know them. They can trust you. They can see what you're trying to do so that they can advocate to the bank why they should do that loan. If you find a good one that has an appetite or has had past appetite for whatever project you're trying to finance, now would be the time to open up an account with them, put your money with them, have a relationship with them, show them that you know what you're doing, and I think that'll go a long way. It might not get you there, so there is some risk in doing that because once again, banks are cyclical, and maybe they don't have an appetite today, but you have an opportunity today. And that's where your other relationship that you started with the banker would come in, and you could go to them and see if they have an appetite. So I think it's important to have multiple facets of those relationships.
And one thing about us is that we all have relationships with other bankers, right? Mm-hmm. So I may tell you, hey, I can't do it, but these guys can, right? So that's one of the key things about the relationship. Like, we're gonna be honest. We sit there. I mean, at the end of the day, we're all in sales too, right? We hope that we can get that business. However, if we can't get that, we're gonna also refer it to someone that we trust that's going to steer you in the right direction as well.
Another thing I would add is just executionally. I'm not sure if that was a part of your question, but I see a lot of different developers and investors at different stages in their career. And the way that I see a lot of newer people get into the business is by partnering. So you partner with an experienced developer and investor. You play a critical role in a few projects as a partner to where you've then demonstrated that you have the requisite experience to maybe start out with a smaller project. You do that successfully and you just continue building your way up. But partnerships are a good way, executionally.
Title on the Rocky.
Yeah, that's a great segue into, the other part that I kind of want to touch on is just getting into teeing up people for, whether it's now getting that relationship going, trying to be in a good footing when things do change in the market. I know me personally as an investor, the first place I go ask for money is where I keep my money, right? That just makes sense to me. You guys have been holding my money, so I expect a different answer from you than some bank that I don't have deposit accounts at. So with that, obviously we talked about having deposit accounts, getting that going. Are there rookie mistakes, anything that you guys have seen through your experience that maybe be good for them to hear and not go down the same path when they're trying to court you guys?
I'm gonna say this: don't let social media fool you.
Yeah.
Because a lot of people get on social media making it seem like it's awesome. I got some friends that are in this room. There are investors in real estate, and they tell you it's not that simple as you guys make it. They make it seem to be on social media. Really focus. Like if you don't have, and I'm saying this from a perspective of I'm an investor as well, right? If you don't have a relationship with a banker, get one. Because when you're sitting down and having these ideas, your banker is going to be like your therapist. They're going to tell you, hey, this probably ain't going to work today. Doesn't mean we can't do it. However, just not right now, right? We need to work on some things. Goes back to what we talked about, creditworthiness, balance sheets. A lot of rookies, if you want to use that language, right? They're coming in and say, what's a P&L?
Oh.
Right? What's a Schedule C?
They need to come to our classes.
Mm-hmm. Listen, but they don't know, right? So I've seen that, over the years of me. I've been in, banking over 13 years. I've seen that happen where, they say, hey, I think I make a lot of money. I want to get into, doing some investing in real estate, but they have no idea, right? So that's one of the keys. And then another part of it is, I've seen some that say they want to buy duplexes or commercial buildings. I understand what their rent roll is before you even try to think about getting it. Because we've seen people say, oh, I think this is a great property. Why? It looks great. Okay, why? Right? And then you say, hey, have you received a rent roll from the previous owner? No. Okay, so you're wanting us to lend money on something that you have not even received any documentation on. I understand what that rent roll, because at the end of the day, that's what really is going to pay that loan. You as a person is one part, but that's the part that's really what we're looking at. So that's what I've seen over my time.
I'll give you a little bit of advice to kind of piggyback off of that, is understanding everything that you need, but have all of your financials on a Dropbox, updated every quarter, every month, have your tax returns. I would even go as far to say as have like a CV or resume of here's who I am, here's my history, here's my education, just so that the lender, especially if they're a new lender, knows more about you. That cuts a lot of time in half. But one of the biggest mistakes that we see is we get a great opportunity, I need to close in 45 days, and then we send a big list of things that we need. And these are things that I don't care about. I mean, I do in the sense that I want to make sure it's approved, but some of them you're like, well, why do you need that? Well, a lot of it comes with, our policy, regulations, things that we have to collect. Some banks, and I'd say a majority of them, won't even look at your file as far as an underwriter until you have all of those docs uploaded so that they can look at them.
Surely.
And so we might have a 45-day close and we're waiting on a W-2, even though we can see the income on the tax return. And they're like, why, and that's, have it ready, call them up, send it to them in a folder, and keep it up to date, because that will delay your project. And the second thing I'd say is, we were talking about this earlier, is don't take it personally. You're gonna call your banker, and you might have your account to that bank, and they're gonna tell you no. I think that everybody here will tell you that we want to lend on commercial real estate. All banks want to lend on commercial real estate, but there's more at play than just this amazing opportunity that you have on your plate. There's a lot of back-end stuff that you might not be aware of. So it might be a no, and it doesn't mean that you can't go back to that banker at another time and ask them, hey, I have another opportunity, will you look at it? Some people get offended. I found this great opportunity and you guys are not supporting me, and they don't like that banker anymore. And that's just not the case. The banker wants to help you, wants to get there, but you got to help them and understand that sometimes it's not the right timing for the bank.
I agree with everything that's been said, but maybe I might ask a question if it would be meaningful to share maybe a different perspective that's not necessarily someone looking at a piece of property and going to a bank and trying to explore that due diligence process. I suspect many investment opportunities would be investing in an opportunity that someone else has put in front of you. A developer or investor is saying, hey, would you, here's an investment package, would you like to invest in it? And that's where I've seen some big mistakes made early on. It's really important to vet those packages because they're all shiny and glossy and they look great. They look fantastic. But do the assumptions make sense? Can the rents that they're projecting, can they obtain those in the current market? Is the occupancy that they have forecasted for this wonderful project that they're going to build, does that line up with the market vacancy? Do the costs make sense? Or are you going to put your money to work and then 3 months in there's a multi-million-dollar change order from the contractor because the costs never made sense? Well, and that's when that phone call comes around to the investment group that which you're a part of, that you either have to write a check or your investment gets diluted if other folks decide to. So that's maybe a little different aspect of real estate investing, but it's really important. And the last thing I would say, and believe it or not, this happens. You guys have probably seen it as well, and this is a little self-serving. Make sure they have their financing in place, because the last thing you want as an investor is you and others put your equity in a deal and they start spending it, and then that runs out and the loan has never been put in place for the rest of the capital stack. Believe it or not, I see that.
Wow. Yeah.
So, hope that's a little different spin, but hope that's helpful.
I think I missed your question. Sorry.
Yeah, it ties into actually what you guys kind of were just talking about. But I mean, there's a lot of talk in the market right now about distressed debt that's already on banks' balance sheets, and like the problem is a lot of those deals from an acquisitions perspective are undesirable. Like a lot of them are C-class or office assets or stuff like people don't want to buy really for prices that are reasonable. And so, like from a bank's perspective, I've been hearing some lenders say like, yeah, those deals might trade to people we already have relationships with on our balance sheets quietly so that we can maintain the debt or something like that. But like, what is your position on that? What do you think is going to happen? Are you guys going to work with people on your balance sheet that are distressed to like maybe not liquidate and to work it out? Or are you going to just as soon as possible get it off your balance sheet because it's already a loss and we might as well use that capital elsewhere? What's the thought process there?
Good question.
I'm happy to share my perspective, and I ran a workout group years ago, so unfortunately have a fair amount of experience. I've seen a lot of capital come together quickly to take advantage of distressed asset opportunities. But I'm curious to get your thoughts as well, but I haven't seen those materialize in a big way yet. They may. If interest rates stay high, they may, particularly in the office asset class, but I haven't seen them materialize. And what I've seen, particularly as a multifamily and industrial financier, is even though costs have gone crazy and interest rates have gone up significantly in many of the markets, including Nashville, rent growth has been 20% over the same lifetime of that project. So if you're financing a speculative industrial building or an apartment project during the period of time that it was being constructed and those interest rates took off, the rent growth took off right with it. So they're still working. So there's not this massive pool of distressed assets that maybe folks thought there would be. Now there may be.
Is that unique to Nashville? I mean, are we seeing more of that?
It's unique to I'd say the southeastern metros.
Okay.
If you think of Charlotte, Charleston, parts of Atlanta, Nashville, a lot of Florida markets, you saw the same thing, a tremendous rent growth. But ones that were maybe financed later on in, if we want to call this a cycle, interest rates hadn't hit their peak, but rent growth had. So those projects which haven't really hit their first maturity yet, they saw interest rates increase above their pro forma, and that rent's flat. So those aren't going to work. So unless we get some interest rate relief over the next 12 to 18 months, you could see that pool of distressed assets grow. And then on the disposition piece, yeah, I mean, generally we start kind of at home with the client base, because I get calls every day from our clients say, hey, you got anything? You got anything? I'm like, thankfully, no, but that's generally where it starts.
Sure.
Can I ask kind of a secondary question to that? Is geography playing a part in you being able to even lend those kinds of things because of, only Nashville proper? If you give the secondary and tertiary markets, are you being more corralled geographically?
I think that is really, and I'd love to hear your perspective. It's bank specific.
Bank specific.
Yeah. So with us, it's more, our footprint to some extent, our lending appetite spans from DC to Texas to Florida and everything in between.
Okay.
And I really focus on the strength of the market, the employment growth, population growth, what are rents doing, what's supply doing. And I make decisions really based on the strength of the market versus any geographic restriction. But I'm not going to California, I'm not going to New York. I'm staying generally in that geographic preference, but it varies bank to bank.
Yeah, I would say, and I know we had this conversation earlier, because it's bank to bank, if you have a property that's outside of the Nashville area, some banks look at it as, hey, I have a relationship with my client that wants to buy a property in Idaho. And because they live in Nashville, they have that relationship, they'll finance that if it's good enough. That being said, location type of situation where it is going to be important where that piece of property is that they can afford it. Kind of a little bit back to your question, I do see that there might be a little bit more distressed properties for maybe even retail. When you think about, they have a 5-year loan and 10-year leases in those retail spaces. During that time, the rates went up and your cap rate was a certain level, but you can't raise that rent or that lease other than the milestones that are spelled out in that lease. And so when it comes to that point to refinance, does that opportunity make sense? Because now we're still stuck with the same amount of money coming in, but now we have a larger loan payment. And so I could see some of that maybe coming into play. But banks, I think in general, are going to want to work with their clients to make sure that doesn't happen. I don't think we want to exit them. If there is an opportunity that we could save this and make it work, we're going to try it, which means that we need to communicate early.
What about the deals that you can't save? What if it's a 50% occupancy, 0.8% DSCR situation where it's not going to stabilize? What are you going to do with that kind of stuff?
Well,
I think that's where we get the phone calls and we find somebody that can come in and take it over.
Yeah.
You just said something, though. I'd love to share a quick story because I think it highlights what you just said. And it's completely counterintuitive. But if you're a banker, if you're one of us, and someone comes to you and says, hey, I have 100% pre-leased industrial opportunity. It's 100% pre-leased to Amazon, credit tenant, cream of the crops. Or they say, I'm going to build an industrial building at this location spec, and then I'm going to lease it at some point in time. Generally, where are you going to gravitate towards?
It's crazy.
Pre-leased, right? Those are the worst deals that we have on the books right now because of his point. So you do a deal with Amazon. Amazon crams down a lower rental rate because there's such a good credit, and then you start the process, and you start construction, you start expending loan dollars. Interest rates took off, but guess what? That low Amazon rental rate stayed right where it was. So it didn't have the opportunity to take advantage of that 20% rent growth because it was contractually set at closing with Amazon. So yeah, you have a great credit, but the cash flow now does not meet the demands of the increased interest costs. Those are the ones that are most underwater. One more thing exacerbating that, I said, the general downstroke on properties was maybe 60, 65%. Well, a lot of banks are incented because of that pre-lease nature to bump that up. So those may be even over-levered at 75, 80%, which makes it even worse. So it's just completely counterintuitive to what should have been attractive now as a problem.
Yep.
Yeah, those are conversations I have daily, weekly. Brennan, to your point about the retail centers, a seller wants a certain amount, cap rate sucks, right? And you're trying to tell them that if someone's taking a loan, they're not even covering the debt service with a net operating income. They just can't quite understand why that is. But it's to your point, it's because they're locked in on leases, and so that's how we can close that delta. But we can't, we can't at least till the lease is up. So that's a really good point. I'm glad that you brought that up because in my world on the retail side, that's where we're at a standstill. I've got plenty of people dry powder ready to deploy, but we're stuck, upside down versus rates and cap rates. So, Tommy, I know you got a question. You've been quiet back there.
Time?
We always got time.
All right, let's go. I was wondering what was the problem with that.
You have like notes, don't you? You're ready.
Yeah.
We're going to do one. I'll say it. And so when it comes to, let's talk kind of negotiations and trying to get a deal done from a consumer's perspective, say an investor's perspective, and what levers are there on the table, right? I think we talked about putting money down, maybe lower interest rates, or obviously balance sheet liquidity, all that good stuff. But I also recognize that maybe inserting deposits into your accounts at a certain threshold for a certain time, maybe that's on the table for negotiation too. Like, help me demystify what's even possible to help negotiate collaboration.
Better than words.
All of those things. I would also say.
We can also say yes.
Yes. Move on. Next question.
If there's nothing else.
I mean, there's always a way. Especially if you have a lot of assets that we can negotiate. Obviously, it helps to have all those things that you just listed. But if you have other real estate that have equity in it, we could place like an abundance of caution on that, or even take a second lien on it. I'd say it's better for you for the abundance of caution. So everything that you have available, you should put on the table. And then work with your lender or your relationship manager to determine, hey, this one first and this one. A lot of the times I'll go to a credit committee and I'll have something in my back pocket. If they turn me down, and I'll say, but what about if we do this?
That's good.
And then they're like, oh, okay, yeah, well, we have that. The borrower doesn't necessarily want that, but I preemptively like, hey, if it comes to this, can I use it? And then that's when, we can get a deal done.
So it kind of goes back, and Tommy, you know me, when I talk about it, sometimes we got to get creatives, right? Well, sometimes we really got to get creative. And sometimes it may not be exactly what you may want to do. However, do you want the deal to get done? If so, here's what we do have to do, right? I've seen deals where, they have one property that's developing, but they got to sell the other property, right? It's kind of that contingency a little bit. However, this property had a lot of equity that we didn't use as the, hey, if this falls through, we're going to use that equity as almost as your collateral, right? You use that as well. So it's a lot of different things that you can kind of pinpoint, but you know, sometimes it takes a little bit of creativity outside of the box standard, and we have to paint the picture to the underwriter to make it make sense.
And Kyle, I think it's important with this question to go back to what you said when we started. This is a point in time.
Yeah.
Yeah.
And the burden of proof is as high as I've ever seen it in my career. You'd asked me this question 3 years ago, and I would have said, can you fog a mirror?
Hello.
Get a loan. And I joke a little bit. It won't always be this hard.
Yeah.
It'll go back to some level of normalcy, because to be honest, there was probably a 10-year run. It was hard to make a bad real estate loan.
Yeah.
I mean, even if you didn't get the investment thesis right and you hit bumps along the road, the market bailed you out for years and years and years. Now that's not happening, so it's gotten a lot more, the details really matter.
We got time for a few more questions.
So I don't know if you have a percentage, or maybe you could talk about, there's a lot of investor gurus that talk about cash out refi, you know, the Burr method, that kind of thing. Can you talk to what are the percentages that you're seeing on the refinance, or to be able to cash out and do that? Has that market pretty much dried up for you also?
Can I throw a new term at you?
Sure.
Cash in refinance.
That's true.
That's more of what we're seeing when things were sized. They were sized in a different interest rate environment. And many loans were sized at 5.5% to 6% to 6.25%.
Yeah.
When they're coming due, they don't chin the bar at today's interest rate environment. So it's more of a, how are we going to deal with this gap versus how much cash can it be?
It's important.
Yeah. Guy Russell, I've seen that quite on some deals I worked with. Hey, if I put $500,000 into this, like we're refinancing, you want to put $500,000 into it, right? And they're trying to find a way to kind of level the difference in interest. They may have been, 5 years ago, maybe 10 years ago, they may even have a super low rate, right? 5%. They come into it and say, oh, where we're at 8%. Oh man, it's a big difference. And if you're already tight, the only thing you can do is they say, hey, well, what if I inject some equity into this deal? How would that help me stabilize and keep the payments where I can still make money and not lose money, and I don't have to worry about that, right? I've seen that happen on a couple of deals that I've done.
So of the prepayment penalties in the length of time that those are there, has that increased?
Not necessarily, for sure.
For loans that would get done today, I think I know that's something I pay a lot more attention to, because look at the interest rate environment we're in. It's a very high interest rate environment. So if we're going to take this finite, precious resource of capital and put it into a real estate loan right now, I want to do that knowing that it's not going to leave the moment interest rates, start to fall. So I think banks generally are putting a lot more emphasis on interest rate floors in the structure and in prepayment penalties.
Yeah.
Interesting.
I don't think they're any longer. I think they're just your typical
3 or 5 years.
Yeah, 3 to 5 years. And I also think it's important that, for some banks, not all banks, but if you have another opportunity that there's equity in this property that they already have the loan on, and you want to do something different with it, that they'll be willing to work with you on a prepayment penalty. Or if you want to use the equity from that property instead of cashing out, once again, use it as collateralize it. Hopefully not cross-collateralize, but do something that we can figure that out. So it's just something to play with.
We're seeing a lot more emphasis on global cash flow, not just individual project cash flow. Or did you see that as a general rule?
Well, I think with the interest rate environment, there's more concern over just general economic weakness, so portfolio weakness. So you have to really understand what someone's total portfolio is doing.
Sure.
Mm-hmm.
In my world, we really do a lot of it's asset-specific finance. So maybe not as much as what some other bankers may look at, because it's kind of a self-contained financing on a project level basis. But more broadly across the banking industry, I see that becoming much more important.
Yep. You take out the borrower, then what's going to happen?
So much more on the individual
Yeah, I mean, it's important. I've seen the deal go south because the business was doing well to do the project, but the person who was the guarantor didn't realize that, hey, I didn't know my personal stuff was going to have to deal with this, right? And so what happened is that his debt service, his global debt service was awesome for the business. Once you put him in it, it dropped. So he went from maybe 6-time debt service to now we're only at 1.75, and that can kill a deal. That can kill a deal.
So my like partner and I are starting to learn more about probate, and that like yesterday we went to the courthouse to get a list of like pending probate, and I just wanted to understand a little bit about like when someone dies and like it's going through probate, so that like government can fund the inheritance, like people come up front to say, okay, I'm related to that person, I have shared like I'm gonna inherit this property or whatever. Like let's say nobody comes up, does the bank kind of hold on to these properties and then sell them in bulk, or how does that work?
I think that row wins the award for the hardest question.
Yeah.
Literally.
Hey, I've already taken one, so
I think it could be both.
yeah.
It could be both. So I hate to give you an it depends answer, but I think it really does depend.
Obviously, that's
An attorney
you're
can
asking if
involve.
there's a loan attached to it, right? Because otherwise, it's the state. Yeah.
Yeah.
If there's no heirs and there's no debt service on it, right? Wouldn't that go to the state level? Yeah.
And whoever takes it over has to be able to finance it.
Pay it, yeah.
You got to be able to pay the bill. So you will be looked at from that standpoint.
So you might get
If it was an open loan and they weren't able to service that, would you guys just liquidate at that point?
Case by case basis.
really. I mean, yeah.
You've seen the real bankers come out in this now. Hedge it.
Yeah.
Yes.
Well, I mean, it really is genuinely, but it really does depend, though. That's
Yeah.
not, I don't think you're being evasive. I think it literally is dependent on the individual,
Situation.
really.
I mean, everybody's going to have I always say everyone is going to have a unique situation, no matter what, right? And so you just got to kind of plan for it. But in your point that you're asking about, it is going to be case by case, because if it's a debt service that's still on it, I mean, it's still got to be taken care of. And if you're inheriting it, then guess what? You're going to be responsible for, hey, are you going to pay for it, or the bank has to do its job to recoup our investment from it, right? So then that's when, if you got a lawyer, you talk to your lawyer how that works after we sell it, how that comes to you or who it goes to or whatever, but that is really case by case for sure.
Yeah, there's also going to be other people that might have money that's due from that area.
Yeah.
So they can attach to that real property and then you're out.
Exactly.
Yep.
Yep.
Goes to the stem.
Yeah.
Well, we're about 5 minutes over. I want to get everybody out on time. The big takeaway, I think, that, in this market that we're in right now, what's imperative is you guys are hearing up here that it's relational, right? It's not transactional. So as investors, as people trying to find, where can I go? What relationships can I develop in lending? And it's the same for brokers too right now. Brian talks about that quite a bit on the multifamily side, how, the investors that take the time to get to know him, to check in with him, they move up on the priority list. Well, now's a great time. It's a little bit slower in the market. These guys were gracious enough to come and I don't want to say face the firing squad. That sounds kind of rough, but there's bankers that I'd rather just stay home tonight, right? Well, these guys are here and they're here to take your questions, to face the public. I mean, it's not their fault. What's going on, they have nothing to do with. But just understand that I don't want to speak for them, but I assume that they probably have a little more time in their schedule than they normally do, and with that, seek them out, get in their calendar, meet up, start building that relationship. Do that with your brokers too, do that with fellow investors. Now's the time to really put your team together, and when things shift, you're going to be light years ahead of everybody else. Because when it shifts, there's going to be people who are like, oh, now it's time to start. And now they're left behind, right? So this is the optimal time to get out and start building those relationships. But thank you so much, guys. I really appreciate it.
Thank you, guys.